So what I'd like to chat to you about today is the 2023, the year of normalization. And why do we say that? Well, firstly, we all know how massive an issue inflation was last year. Major shock to markets, and it looks like inflation is rolling over with the US leading the pack. So it looks like inflation is normalizing, but the jury is still out. Similarly, we've seen bond yields reacting to that shock in inflation with globally synchronized increase of interest rates other than Japan. And it looks like to also be stabilizing with the market even starting to discount some rate cuts towards the end of this year. If we then look at inflation versus valuation, so I've shown you this chart before, and that remains a bit of a left field risk. So the earnings yield of the S&P minus inflation currently a negative, still in negative territory. Only 5 instances of this has happened in the last 60 years, and all 5 of those were accompanied by a severe sell-off in the markets. We saw a bit of a sell-off sort of the first 9 months of last year with a strong end to this year following into this year. So for me, if inflation doesn't moderate further, this remains a risk. And also if the Fed over-tightens. In SA, this is just the prime rate expectations, how that's moved over time. One can see that's also moderated slightly from the October level, but further rate increases still expected, and the market pricing in at least another % over the next 12 to 18 months. Looking at our bonds relative to US bonds, still attractive real return, but not as juicy as it was towards the last quarter of last year. So within the Opportunity Fund, we've had a very high allocation to SA bonds. Into this recent strength, we've taken some profits and increased the cash levels slightly. And why I've also taken it, we don't think all the risk associated with a severe amount of load shedding is compensated for in our bond yields. So, I mean, if you just compare 2022, this is still the end of November 2022, the amount of hours of load shedding compared to 2021 more than doubled, and we've started the year continuing on that path. So again, that is very difficult to grow your economy when you've got this kind of headwind. So just looking at the fund performance, we've been very pleased with the performance over the last year. The fund achieving 10% for the year in what was a very tough market. I mean, the all share achieved 4%, but I mean, if you look at the longer term numbers, 12% over 3 years, almost 10% over 5 years, and since inception, achieving our target of inflation plus 5. This is just on a risk-adjusted basis. So again, quite pleased with that result. On the Sharpe ratio, where you adjust the returns for the amount of risk taken, on the horizontal axis far to the right where you want to be, and on the vertical axis your actual return, also quite pleasing. What's helped the performance, if we just look at the last year, our allocation to Ngela Resources have done particularly well. That's a company that was spun out of Anglos. It's the coal mining business of Anglos, and that, I think, bottomed at about 25 Rand. The share went over 300 Rand a share. In the meantime, you've received 78 Rands worth of dividends. They've indicated that they're going to earn over 100 Rand per share. So because of the strength that we've seen in the share price from a portfolio construction point of view, we've reduced our weighting, but we still think it's an attractive asset to own within the portfolio. British American Tobacco, a long-term favorite of the fund. It's done particularly well. Towards the end of last year, we reduced our position, but it remains a dependable compounder with an attractive dividend yield. The company buying back shares, so still one to hold in the portfolio. The US dollar contributed, as we saw, the rand weakening towards the end of the year. And the whole banking sector actually did fairly well. Absa was our choice and delivered handsomely. And then the other small holding, Hello Group or Momo, which is basically the Chinese Tinder, that almost doubled in the last 4 months. So a very good contributor to the fund. On the negative side, Naspers was a detractor despite the slight recovery we saw towards the end of the, last year, and that the negative contribution was tempered by hedges that we had over Naspers. Also into the strength towards the end of last year and start of this year, we have reduced our Naspers position slightly. Abax Global Equity impacted by global equity underperformance relative to SA equity last year, and we couldn't escape that. Sasol is a recent addition to the fund, but should be a beneficiary of the Chinese opening trade. So just the outlook for the rest of the year. There's high global inflation. It looks like it's rolling over. The base is quite high, but the jury is still out. The risk with that is that the synchronized global monetary tightening that we see, that they over-tighten. The market is pricing in that won't happen. I think it is a risk if especially the Fed really want to make sure that they've killed inflation, but there's the risk of then a recession coming through. On the back of that, we do think the market's already discounting the recession and also putting a lower likelihood of that coming through, with China also, the Chinese reopening also helping, and the Chinese reopening also driving asset prices. So there's been a return of risk sentiment, especially towards emerging markets, and we have been a beneficiary of that. So despite our load shedding issues that we've had, and even with Pala end of last year, the rand's actually been remarkably strong, and that's because foreigners have entered our market again. We do expect earnings downgrades to start coming through probably towards the middle of this year as the base starts to get higher, especially coming from the US companies. So far, we've actually seen earnings surprises on the upside. We don't think it's sustainable with the cost price pressure that they are experiencing. We found better relative opportunities offshore, and to that end, we have shifted some of our allocation offshore, which has been enabled by the Reg 28 changes. As I said, further rate hikes expected locally. We still see some select value in SA equities, but one has to be quite selective. The consumer-facing South African companies in for a very tough time with the pressures on the local economic growth. And despite the recent rally in bonds, they still continue to offer value and offer attractive returns, but we have tempered our view slightly. So just our outlook on asset classes, we still think SA bonds attractive, emerging markets attractive, and SA cash offering a decent yield with the increases that we've seen in short rates. And SA equities have moved from the attractive bucket to fair. The rand probably fair, and US equities, SA property, developed market cash, and bonds looking expensive in our view. So just the positioning of the fund, you'll see, as I said, we've shifted some SA equity exposure into offshore equities. We've also increased the cash levels of both SA and offshore, so slightly more defensive positioning, and the slightly lower bond position than as the end of September, and into January we've taken further profits on our bonds. So that's just in summary the top 10 equity positions. It's just for completeness purposes that I've included it. I've given a bit of a write-up on each share in our top 10. I'm not going to go through all of that now. You can read through that at your leisure. Thanks very much for the support, and we look forward to speaking to you again soon. Yeah, it's a good question. Naspers and Prosus, the first half of the year, detracted from performance, and as we got to the end of the last year, a significant recovery. So luckily with our hedges, we didn't participate in all the pain on the way down, and as Naspers and Prosus recovered, we were beneficiaries of that. And at at more recent levels, we've actually slightly reduced our position. We've shifted some of that position into other Chinese companies. So we do think from a portfolio construction point of view, we've got sort of a diversified positioning and appropriately risk-sized position. Yes, it's quite a good question. Towards the third quarter of last year, we saw some of these Chinese platform/tech companies having been sold off significantly, 70-80% from their highs. But I mean, the companies that we had exposure to all had cash on the balance sheet. Those would be Auto Home, Momo, Hello Group, and Tencent Music. These were also companies where we've known a blue-blooded associate from that company. As an example, Tencent Music, we knew it from Tencent. The Auto Home was owned by Telstra previously, which was sold to Ping An. So we had comfort in the quality of the accounts, strong balance sheets, and from a enterprise value to EBITDA, enterprise value point of view, because of the cash on the balance sheet, these companies have fallen by sort of 80-90%. Now, there's been a significant recovery in most of those stocks. And again, we've tempered our position size from a portfolio construction point of view, but we remain optimistic about the earnings outlook and the return outlook for these companies, especially with the Chinese potential reopening. I mean, to look at the ability to achieve that return, one has to look at the building blocks that you use. And if we look at the different building blocks, and we start in South Africa, you've got bonds, which is the biggest part of our portfolio. There, at sort of 11%, you're looking at the inflation plus 5 to 6% potential return over the next 10 years. So that building block ticks the box. The second one, SA equities. We don't think SA equity is expensive on a relative term compared to global equities or emerging market equities. Decent valuation, attractive dividend yield. It's not going to shoot the lights out, but one should be able to achieve a inflation plus 5 total return. Cash levels have shot up significantly, with prime rate now at over 10% and short-term rates offering you probably above normalized inflation returns. And then you look at the offshore assets, the rand at 17-ish, at fair value, probably strong if one considers all the negative news that have flown through over the last that have come through over the last 2 months. So you're looking at offshore assets that hopefully through our stock picking one will add a bit of value, and maybe the rand also contribute a bit more. So we do think the inflation plus 5 target is achievable, and probably easier now than where it was 2-3 years ago.